Hi, good morning, guys. Welcome to this week's seminar, our webinar. So this week we are going to we're going to do a review on the results of 4 companies under our coverage. So we have Fraser Centrepoint Trust, we have First REIT, and then after that we have Cash, and lastly we have SETS. So we first go on to do Fraser Centrepoint Trust. Gross revenue increased, and this is mainly contributed by Changi City Point, because Changi City Point was acquired only in June last year. So only in this financial year, then you will start to see the full contribution from that shopping mall. So based on what was our key takeaways from our meeting with management last week, the portfolio of Fraser Centrepoint generally remains stable, with the exception of Bedok Point. So Bedok Point, the occupancy dropped to around 85% from last quarter that was about 94%. And this is mainly because of K-Box, the karaoke chain, which left the premise during the last quarter. So talking about Bedok Point, this is not a very huge portion of FCT's portfolio. If you look at it from a valuation point of view, Bedok Point is just a mere around 5% of what FCT holds. So their main malls are still Causeway Point and North Point. But the thing about Bedok Point is, because ever since Bedok Mall started in December 2013, occupancy started to suffer. So along the way, sometimes they manage to bring it up to 100%, but along the way you see occupancy start dropping again. And this mall has become somewhat like a weak link in the portfolio of FCT. So today we're going to touch and maybe look at Bedok Point in specific and examine what exactly is causing these fluctuations in the occupancy. So if you look at Bedok Point, right, it is a mere 5 to 10 minutes walk away from Bedok MRT. It's not that inconvenient. In fact, it's pretty convenient. But you see that after Bedok Mall started, the occupancy dropped, and it's not hard to figure out why, because if you look at Bedok Point, it's a pretty smallish mall. Their NLA is only about a third of what Bedok Mall has to offer. And every mall they have to apportion some of their NLA to F&Bs. So after leasing out some of the space to F&Bs, Bedok Point actually do not have much of remaining space to actually offer that kind of range or variety of offerings versus Bedok Mall. So you compare the two malls, right? You look at Bedok Mall and you look at Bedok Point. Bedok Mall has so much more things to offer. You go under one shopping mall, you have a much wider variety of things that you can buy. So, and then for Bedok Point, they do not have much of an anchor tenant per se as well. Because if you look at the basement floor of Bedok Point, they're actually occupied by Challenger and Harvey Norman. So these two considered the mini anchor tenants. Actually, if you examine their ability to try to attract crowds to that mall, right, it's actually not much of a pull factor because Bedok Mall has similar offerings. Bedok Mall has Best Denki, and they actually sell pretty much the same stuff. So it doesn't make much sense for shoppers to walk the extra distance to Bedok Point to grab that kind of stuff that they need when they can get it at Bedok Mall. And then if you look at Bedok Point, they actually have a substantial portion of their space leased out to services retailers. So you see them offering spaces doing like foot massage or tuition centers. And these retailers actually they they attract the kind of shoppers they attract are the shoppers who go there with a very specific purpose. So unless I want to bring my kids there for tuition, unless I want to go there for a foot massage, I wouldn't really, or unless I know that there's something, a food chain that I like. I want to go to Paradise Inn at Bedok Point, for example. It's with a specific purpose. So in trying to attract shoppers who walk around the malls on a more leisurely basis, these offerings that Bedok Point has actually I would say pale in comparison when compared to Bedok Mall. So in that sense, the shopper traffic there will be lesser than that of Bedok Mall, and that is why I think that is why you are seeing that in the rentals that the two malls can command. Based on our rough calculations, we see that Bedok Point actually command rents in the high single digits, but Bedok Mall, despite being just a short like 5 minutes walk away, their rentals are in the high teens, right? So both malls in the heart of the Bedok town center, but the difference in rental can be so huge. So management is trying to reposition the mall. You see that the top level now is being occupied by tuition centers. They're trying to make it such that there is this synergistic. When parents bring their kids there for tuition, then they can sit around Starbucks or check into Paradise Inn to enjoy a meal or two while waiting. So that is the kind of direction they're taking, and I would think that we should give management some time to reposition and stabilize the mall. And another key takeaway we saw in the briefing that we had with management is that F&B outlets tend to perform better in the current retail climate. So in the recent months, we saw that retail sales has been lackluster, and for FCT is a good thing to note that in this kind of latest trend that they are noticing, in that F&B outlets are performing better, we see that for FCT they have about 34% of their gross rental coming from F&B outlets, versus if you compare them to the nearest competitor, Capital Land Mall Trust, they only have about 27% of their rental coming from F&B. And in our meeting with the CMT, Capital Land Mall Trust management, they also noted the same thing essentially, was that in this period of tough retail sales, necessity spending shops are actually holding up much better. So in view of the fact that FCT's portfolio is primarily necessity spending, we think FCT is going to hold up better in the current retail climate. So next up we have First Street. Similarly, property income grew because of new contribution from the malls that they acquired in May and in December last year. So for First Street is essentially a growth story. It's an acquisition story built primarily on the increased demand in the Indonesian healthcare sector. So we see that the fundamental growth drivers in the Indonesian healthcare sector remains intact. This is going to be driven largely by the universal healthcare insurance that is going to be progressively rolled out by President Jokowi's team until 2019. So this universal coverage is going to increase the demand for healthcare facilities in Indonesia. And we see that since the time we initiated until now, the First Street sponsor or parents, that is the Lipo Group, their portfolio of hospitals actually increased. So there is a bigger pipeline of hospitals for First Street to acquire right now. And another thing that management noted is that for First Street, they introduced this distribution reinvestment plan, also called the DRP, and it's been ongoing for 7 quarters. So the participation rate ranges from 23% to 35%. So in that, every 10 investors you see, a quarter of them will take their dividends in terms of new units in the company. And from that point of view, we also like to note that for First REIT's biggest shareholder and sponsor, Lipo Group, each single quarter they actually subscribe to the maximum allowable uh, the shares that they are allowed to take up. So that's a sign of confidence that the parent displays in the First REIT. So we have said in our initiation report that First REIT is primarily an acquisition story, right, based on the growth in the healthcare sector in Indonesia. And over the past few years, we see that every year on average, they will acquire 2 hospitals from the parent as part of the capital recycling process for the parent. But so far this year, we are already in July, and we have seen that First REIT has been pretty quiet on the acquisition front line. And management has guided that they are actually actively still looking out for possibilities of new acquisitions. And I think the next one could be just round the corner, because I think a very good clue could be from, if you look at First REIT's website, their announcement page, every single time they do an acquisition, they will set up this wholly owned subsidiary, this holding vehicle for them to hold the new hospital under. And if you look at the announcement, just I think last month or sometime back, a very short while back, they actually incorporated this new wholly owned subsidiary. This is called the name they gave it was something like SHKP. So my suspicion is SHKP would stand for Siloam Hospital Kupang, because Siloam Hospital Kupang actually is one of the hospitals in the pipeline that they shared in their results slides that they say is a possible acquisition target. So I think with that incorporation of their new subsidiary, we are actually looking at the next acquisition just around the corner. It shouldn't be too far away. So in that sense, I think the acquisition story, the growth story for First REIT is still intact, and that's why we still have an accumulate call on it and a target price of 155 from here. So next I'll pass on to Richard to touch on cash and sets.
Hi, good morning. This is Richard speaking. So now I'm going to speak about Cash Logistics Trust, which announced their second quarter results last week. Okay, so first the gross revenue. You can see that the gross revenue increased year-on-year by 3.7%. Next would be the net property income, which was lower by 5.4%. This came about due to the high expenses associated with the conversion of 3 of their master leases to multi-tenancies. And distributor income was flat. This distributable income of 16.8 million actually includes a partial capital distribution from the proceeds of divestment of the Kim Peng warehouse. It was divested for about 9 million, and they are paying out about 1.4 million of the cash in this quarter's distribution. And the DPU for this quarter is 2.14 cents, which is 0.3% lower than the previous quarter. Qualitatively, we'll look at a portfolio update. So the portfolio still enjoys a high occupancy of 98.3%, and it has one of the longest WALE for all the industrial REITs at 4.5 years. The portfolio consists of 11 completed warehouses in Singapore, 1 in China, and 3 in Australia. Out of one of the warehouses in Singapore, it's a built-to-suit for DHL, and is located at the Tampines Logis Park. Next, talk about the lower NPI. As I mentioned earlier, is one-off as master leases roll over to multi-tenanted. Well, it's a one-off for each of the master lease, but it will happen again next year when 3 of their master leases roll off as well. These 3 buildings are the Schenker Mega Hub, High Speed Logistics Center, and the Air Market Logistics Center. These will the master lease agreement will end in the third quarter of next year. So for lease renewal profile for the REIT, for 2015, actually there's very minimal risk. Only 2% of the portfolio by NLA is up for renewal this year, for the remaining part of this year. And for the 3 master leases, in 2016, they make up about 12% of the portfolio NLA, and the total uh, amount of leases for 2016 that will expire is actually about 16%. So the lease renewal profile for the portfolio is actually quite manageable in light of the large supply of industrial space that's coming online this year and next year. And about capital management, the gearing now is at 38%, which is quite high, but the REIT does not have any refinancing due until 2017. So for the next 2 years, they don't have to refinance. So we still like Cash Logistics Trust for their portfolio of new and modern warehouses, which are of the ramp-up design instead of the legacy design of cargo lift, and the portfolio warehouses are located at good locations, and the REIT still offers an attractive dividend yield of about 7.2%. Moving on to SATS, which also announced their results last week, there was an improvement in their margins. But I'll talk about the numbers first. For food solutions, the revenue was lower due to TFK, which is their food catering subsidiary based in Tokyo, which serves the Narita and Haneda airports. They had a divestment of Urangan fisheries and the transfer of their food distribution business to a new joint venture, SATS BRF. So if you look here, I mentioned about the improvement in margin. So at the EBIT level, uh, the margin improved year-on-year from 9.1% to 10.6%, and for PATMI, the margin improved from 10% to 11.3%. Now, some of the updates that the management gave during the analyst briefing, they said that the full 20% of the Changi Airport rebates will not flow through to SATS. So actually, Changi Airport has had announced that they are giving 20% rebate to the ground handling and catering providers at the airport. But SATS has clarified that not all 20% will go through them, and some negotiations are still ongoing. So the final details are not known yet, but management guided that the amount of licensing fees that they are paying in this quarter would be roughly representative of what they would be expecting going forward. Second is a lower cost of raw materials. So this is where they had some cost savings which actually improved their margins. They attributed their lower cost of raw materials from supply chain management within the group and scale in purchasing for both their aviation and non-aviation segments. What to look out for second half of the financial year, that would have that you will see stronger numbers is that firstly they have regained the Jetstar ground handling account at Changi. So you may have read in the newspaper that you may have read in newspapers in June that there were some problems with the ground handling provider for Jetstar, and so SATS has taken over effective from 22nd of July. Actually, SATS had lost the Jetstar account last year, and now they regained it in within about 6 months. So that's one of the aspects that you can look forward to for SATS. And secondly, TFK Catering, which is based in Japan, they also have a contract with Delta Airlines. Okay, we've come to the end of the presentation, and we'll wait for some questions now.
Hi, Dahong here. There's a question on first read, and it says that first read seems very positive from all angles, but what are the risks? So first read, our thesis, our investment thesis is that this is an acquisition story, right? Based primarily on the fact that we expect the demand for healthcare services in Indonesia to be ramped up, and this is because there is this healthcare insurance, right, that the Jokowi team is trying to roll out, and they're trying to get every single Indonesian to be covered under this insurance plan by the end of 2019. So primarily based on this fact, we think that there's going to be an increase in the healthcare demand, and based on what First Street's parent is doing, and that is that they are ramping up their network of hospitals at a very rapid pace in this period where demand is expected to increase. So we think that this will actually increase the exposure and the visibility and the brand awareness of the hospital, of Siloam Hospital. So I would say from a risk point of view, any kind of difficulties or delay in the rolling out of the universal healthcare in Indonesia could actually impact the demand for the healthcare, and that could actually slow down the rate of the ramping up of the hospital networks for the Lipo group. But we know that actually for First Read and Lipo Group currently, they actually have they in their pipeline there is still a very large number of hospitals yet to be acquired. So there is still a bit of buffer there. And for currently the current status for First Street's hospital, we do not see any slowdown in the demand. The hospital's occupancy are still doing pretty well in the high 60s region to the 80s region.
Hi, this is Richard speaking. So there's a question, do you think REITs prices have factored in the impending Fed rate hikes? And there's another question about, with interest rates expected to rise the coming quarters, the prices of most REITs will be affected and may be a bad time to invest. In any comments? Okay, so I'll tackle these two questions simultaneously. So for rising interest rates is everyone knows that is a monetary tool used by monetary tool to combat rising inflation, and inflation is normally associated with improving economy. So what we see is that in an improving economic situation, businesses will be in expansion mode, and so they would require industrial space. And likewise, for expanding business, it's associated with jobs creation as well, and that would lead to demand for commercial space. And together with jobs creation and higher income levels, there will be demand for hospitality and retail segments as well. So overall, these signs of in the these signs of increasing interest rates associated with an improving economy does stimulate demand for the kind of products that the REITs are offering. And on the other front, we would comment that if you don't invest in REITs, then what would be your other alternatives? If you leave the cash in the bank, your bank account, uh, the bank is not going to give you the additional interest rate. And if you say you go and buy a bond, the bond will pay you a fixed coupon, whereas for the REIT, you actually do have some participation on the upside coming from the increase in rents that the REITs will charge. Because as a landlord, and if there's demand for their properties, then obviously they can charge a higher rent. And so what we think is that for investors who do believe that the there will be a correction when the interest rates increase, we think that that is a good opportunity to buy in on a knee-jerk reaction which is unwarranted.
Hey, Maria. Your question on the currency risk for First REIT, as the hospitals are based in Indonesia, there is no currency risk for First REIT because the rentals they are getting from their parents, who is the lessee for their hospitals, the rentals are all in Sing dollars. And the valuation of the hospitals is also done in Sing dollar terms, because when the valuer goes to the hospital and do a valuation, right, they actually look at the cash flows, and when the cash flows are in Sing dollars, the valuation actually was done in Sing dollar as well. So currency risk, I would say, if you're worried about the depreciating rupiah, then there's not much of a risk there because First REIT receives rental in Sing dollars. Hi, there's a question on First Read again. Whether First Read is looking to buy hospitals in other regions such as Australia or China or India. So in the analyst briefing, we actually heard something from management about them exploring the idea about hospitals in China. But then I think that is still a pipeline dream, and I don't think that will be materializing that fast. But management is indeed looking at China, and I think in the second or third tier cities where, because I think in the first tier cities the yield might be a little too compressed. But like what I said earlier on, it is still a it is still a pipeline dream. I don't expect it to be materialized anytime soon yet. So the primary focus for now will still be on Indonesia. And for first read, the yield for the FY15 estimated yield is about 6.7%. Hi, there's a question on Bedok Point again. And okay, the question is about Bedok Point. Why is it not able to coexist with other malls in Bedok? Like what we see in Tampines, right? We see Tampines Mall, we see Century Square, Tampines One coexisting and all doing pretty well, or Jurong East area, right? So, like mentioned in the presentation just now, I think for a mall to be to okay, firstly is because Bedok Point, given its scale, right, the NLA is only about one third of Bedok Mall, and Bedok Mall itself is already not a very large mall. So, and Bedok Point is only just one third of it. And after minusing off away some portion of like F&B, which is a must-have in your malls, right? Your remaining space, you actually do not have much you do not have too much space to offer shoppers a wide variety of offerings. So in that respect, right, in when you have a mall like that, your shopper traffic, you would not have too much of those kind of shoppers who go there on a leisurely basis. For those of you who stay in the east or who stay near Bedok, if you have gone to Bedok Point, you would have noticed that they have too many of this kind of services shops where you go there just for that purpose. You go there just to, send your kids to the learning lab. You go there just for your foot massage. You it wouldn't be a mall you would tell your friends, hey, let's go there for shopping, man. Like because it doesn't offer much of that kind of variety, like fashion, for instance. So I would say that would be one of the reasons why there would be some difficulty for management to pull in the crowds at the moment, especially when Bedok Mall is just open and the hype is there and they are able to offer a bigger variety of offerings. But then again, I think it's already reflected in the rentals, like what I said. Bedok Point's rental is just half of what Bedok Mall is having, right? Then the management is trying to reposition the mall, and I would advocate that we give management some time to build up the occupancy and the repositioning of the mall. But that being said, I think in Bedok, like if you look at Bedok Mall now, it's already fully occupied, right? So from here onwards, retailers who want to gain some access to the residents or the catchment, the crowd in the Bedok estate, you pretty much do not have much other options other than Bedok Point. And I think it still remains a viable option for retailers to capture and to expand to in the Bedok region. Hi, there's a question on online shopping and its impact on malls. So I think for Singapore, malls have evolved to be somewhat kind of like a lifestyle place. It's not primarily for shopping. It's a place where we congregate, we have our gatherings or we meet friends, and then like also mentioned before in this FCT's management meeting, right? In the current retail climate, the retailers who are holding up better are the F&B outlets. And in CMT's meeting, we also note that management pointed out the exact same thing. They say that necessity spending in this retail climate, necessity spending is actually holding up much better. So in that sense, if you have F&B holding up better, necessity spending, necessity outlets holding up better, better than discretionary shopping, right? Then you look at FCT and the portfolio they have, primarily suburban, primarily necessity spending, 34% of rental income coming from F&B versus 27 for CMT. And then you look around the FCT portfolio, the main malls, the upcoming supply is also very little. So in that sense, these are all very bullish factors. Because if we talk about suburban, right, we actually have to look a lot about the demand and supply as well. Like if you look at CMT, if you consider Jurong East is a very is suburban as well, right? But CMT has this J cube which is suffering because Jurong East is just oversupplied with malls in the last few years. They had Gem coming up, they had Big Box, they had all these new malls, which actually just makes the attractiveness of J cube lesser. So in that sense, I think FCT has a lot of positive factors going for it. Alright, if there are no further questions, we'll end our webinar here. Thank you for tuning in and please tune in again next week.